When the Fed started increasing interest rates back in 2022, the effects of that were immediate in a few ways. The share prices of stocks began to fall because interest rates and the stock market have an inverse relationship with each other. Additionally, it slowed down growth for a lot of businesses that rely on borrowing, such as real estate and utility companies. But specifically for the dividends companies were paying, it didn't have too much of a negative impact back then. We didn't see widespread, immediate dividend cuts when rates started going up. Most companies that were paying dividends back then didn't have any issues with continuing to carry out their distributions to their shareholders. A couple of sectors, including BDCs and some debt-holding closed-end funds, actually benefited from rising interest rates. Specifically, investments that held floating-rate debt actually increased their dividends very aggressively between 2022 and 2023 because they were earning more income. However, when 2024 rolled around, we started seeing the effects of interest rates remaining higher for longer. As this year's continued on, though, we have been seeing a number of companies and a couple of entire sectors starting to struggle with paying dividends. And with the Fed expected to start cutting interest rates next month, we're hopefully going to see a lot of relief for some of these companies. In the past year or so, we've been seeing a sizable uptick in the number of dividend aristocrats and dividend kings that have fallen. One of the most well-known dividend kings to fall was 3M back in May. After 65 years of consistent dividend growth, they cut their dividend from $1.51 per share to just 70 cents per share. We also lost another dividend king this year, which was Leggett & Platt. After 51 years of dividend growth, just finally becoming a dividend king, the home furnishing company obliterated their dividend, going from 46 cents to just 5 cents per share, an 89% decrease. Then there was also Walgreens, who were removed from the dividend aristocrat list back in February. They were almost a dividend king, having raised their dividend for 47 consecutive years. But they cut their dividend by 47% after the company's been struggling for many years. Last year, VFC Corp lost their dividend aristocrat status and were forced to cut their distributions. A few months ago, though, they were forced to cut their dividend yet again due to issues revolving around increasing inventory. Then, of course, there was Intel, who lost their aristocrat status last year as well. From my experience, it's rare to see this many dividend kings and aristocrats lose their status in such a short amount of time. I know we're only talking about 5 or 6 companies in a little over a year, but there's currently only 67 dividend aristocrats that exist. It's common to go years without seeing one of these companies having to cut their distributions. So this is definitely a concerning trend because when you think of dividend kings and aristocrats, you typically think of safety. When times are tough, people typically tend to invest in these kind of holdings for safe dividends. But there's no high-yielding sector that has suffered more in the last year than mortgage REITs. These are companies that typically follow the same strategy. They borrow lots of money to buy pools of mortgages and mortgage-related investments, and they use a lot of leverage. When interest rates started increasing, it greatly reduced their investment spread since borrowing money became more expensive. And since they're required to pay out 90% of their earnings to shareholders, it's resulted in some pretty difficult times for these companies. In the past year, there's been a lot of M-REITs that have been forced to cut their dividends, or they're getting really close to. The biggest M-REIT, Annaly Capital, was forced to cut their dividend last year, and since then they've been hovering around a 100% payout ratio. Orchid Island Capital, who just went through another dividend cut less than a year ago, posted some disastrous results last quarter. They lost 9 cents per share, nowhere close to covering their 12-cent monthly or 36-cent quarterly dividend amount. Also reporting a sizable loss last quarter was Dynex Capital. They have a history of dividend cuts, although not nearly as severe as Orchid Island. Ellington Financial's latest results were pretty poor. Their dividend payout ratio is currently 118%, so unless they can post some much better results soon, they aren't going to be able to sustain their monthly dividend at its current rate. Two Harbors Investment Corporation is another company that's failing to cover their dividend as of last quarter. Their stock currently has a payout ratio of 104%. New York Mortgage Trust is also reporting a big loss in their previous quarter, not even coming close to earning enough to pay their dividend. This company got absolutely demolished in 2020, and again, they're still getting crushed. What's unfortunate is that even Starwood Property Trust, one of the only few M-REITs that's historically been really good, is going through a much more difficult time. Last quarter, they reported that their dividend payout ratio is currently right at 100%. This is somewhat common for this company as they've been hovering around 100% for a while, but we'll have to wait and see if they can maintain their perfect no dividend cut streak or if they'll also fail. And it just keeps getting worse for this sector. A huge letdown occurred a few months ago with Blackstone Mortgage Trust, ticker BXMT. This M-REIT went over a decade without a dividend cut, one of the best streaks in the industry. But in part due to their large portfolio of office-related investments, the stock had to cut their dividend from 62 cents to 47 cents. We have been seeing a handful of REITs that are doing okay this year. Currently, AG&C is more than fully covering their dividend. There's still the issue of their book value continuing to fall, but for now at least their dividend is paid for. A company I've never talked about before is Ladder Capital, which is another REIT that's doing pretty well. What makes this one different is that they have a large number of physical properties on top of mortgage-related investments, so this makes them more of a hybrid REIT than just a mortgage REIT. So far this year, they're doing pretty well despite holding a lot of office properties. When we start seeing rate cuts, it'll likely really benefit all of these companies I just mentioned. But as I've been preaching for the longest time, the majority of REITs that exist are pretty mediocre in terms of being a long-term investment. Even during better times, these companies have gone through many dividend cuts. They can make for good short-term holds, but I usually don't support the idea of retiring off the dividends of an REIT, again with a few exceptions. There is another sector that was doing really well, but is now showing some signs of strain. We've now started seeing a handful of business development companies struggle with rates remaining higher for longer. As most viewers of this channel already know, these BDCs provide financing to small and medium-sized companies to help them grow. They're pretty similar to private equity funds, only they're publicly traded, and they're one of the best investment types for people looking for high dividend income. As I discussed in the beginning, between 2022 and 2023, these companies were really boosting their dividends because they were earning more from their floating rate investments. Because the companies that were receiving financing from these BDCs took out floating rate loans, this means that their payments went up as interest rates went up. So a lot of BDCs have been earning more money, which they've been paying to shareholders. We saw a lot of them pay special dividends and grow their normal distributions. But some of these BDCs are now reporting higher non-accruals, meaning that their borrowers are struggling financially. When rates do get cut, it will result in fewer special dividends being paid and probably slower growth, but it should also result in lower non-accruals, which will translate into safer, sturdier dividends. The good news is that there aren't too many BDCs that are currently having issues. All of the big name players in this sector are still doing pretty well, including Ares Capital, Main Street Capital, Blue Owl Capital, Hercules Capital, and so on. But one BDC that I used to be a shareholder of is Triple Point Venture Growth. This company continued to post worsening results this year and just a few weeks ago announced a dividend cut. Fortunately, they're the only BDC to announce a dividend cut this year as far as I know, but there are a couple that are getting dangerously close to cutting their dividend. One BDC that's coming very close to reducing theirs is Horizon Technology Finance. Their payout ratio has gone from 73% to 86% to now 91% as of last quarter. Another BDC showing signs of weakness is Oaktree Specialty Lending Corporation. They've also reported a growing number of non-accruals and their payout ratio is getting closer to 100%. So that's a look at the current state of the BDC sector in 2024. Still largely doing pretty well, although some have retracted in share price in the past couple months. One more area that's more or less stabilized this year would be office REITs. Most of these REITs got wrecked in 2023, but fortunately to my knowledge, there haven't appeared to be any major dividend cuts this year among these corporations. However, many are still showing signs of strain, and as a result, they could get worse if there is a recession. So in summary, things have been heating up among a few dividend-paying companies and sectors this year, but interest rate cuts are definitely going to benefit people who hold these alternative investments known for paying high dividends. If there is a recession coming, these rate cuts will at least lessen the impact. All we can do is watch and see what will happen. But with that being said, that's going to conclude today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.